Debt is often perceived as a financial burden that should be avoided at all costs. However, for the wealthy, debt is not just a liability, it is a powerful tool for creating and amplifying wealth. Traditionally, debt has been associated with high interest rates, unmanageable payments, and financial stress. However, when used strategically, debt can offer significant advantages that far outweigh these drawbacks. Wealthy individuals understand that leveraging debt can provide access to capital that can be invested in high-return opportunities, often leading to exponential growth in their net worth. They use debt to finance investments in real estate, businesses, and the stock market, capitalizing on low interest rates and tax benefits. The key difference lies in their approach to debt management. Instead of viewing debt as a last resort, the wealthy see it as a strategic asset. In this video, we will explore the strategies rich people use to make money with debt, turning conventional wisdom on its head. But before we move on, please drop a comment saying, "I am worthy of living a luxurious life." Positive affirmations attract good things into our lives, so comment, "I am worthy of living a luxurious life." When I see your comment, I'll give it a heart. Now let's continue. One of the most common ways wealthy individuals use debt to build wealth is by leveraging low-interest loans to make high-return investments. This strategy hinges on the fundamental principle that the cost of borrowing is lower than the potential returns on the investment. Leverage involves using borrowed capital to increase the potential return on an investment. For example, if a person borrows money at a 3% interest rate to invest in an asset that generates an 8% return, the difference of 5% represents the profit made from leveraging the loan. This approach amplifies returns while keeping personal capital invested in other opportunities. Real estate is a prime example of how low-interest loans can be used effectively. Wealthy individuals often acquire properties using mortgages or other forms of real estate financing. The rationale is that while the cost of borrowing may be relatively low, the rental income and potential appreciation of the property can yield significantly higher returns. For instance, consider a luxury real estate investor who secures a mortgage at a 4% interest rate to purchase a multifamily property. If the property generates a 10% return on investment through rental income and appreciation, the investor benefits from a 6% net return. Over time, this strategy can lead to substantial wealth accumulation, especially when combined with property appreciation and rental income growth. Another area where low-interest loans are utilized is business investment. Entrepreneurs and business owners often use loans to fund expansions, purchase equipment, or invest in new projects. The key here is that the returns from these investments typically exceed the cost of borrowing. For example, a business owner might take out a loan at a 5% interest rate to expand their operations. If this expansion results in a 15% increase in profits, the business benefits from a 10% net gain. By using borrowed funds to finance growth, the business can scale quickly and increase its overall value. Debt can also offer significant tax advantages, making it a valuable tool for the wealthy. Understanding and leveraging these tax benefits can lead to substantial financial savings and enhanced wealth-building opportunities. One of the primary tax benefits associated with debt is the ability to deduct interest payments. In many jurisdictions, interest on loans used for investment purposes or business activities can be deducted from taxable income. This deduction reduces the overall tax liability, allowing individuals to keep more of their earnings. For instance, if a wealthy individual takes out a loan to invest in a business and pays $50,000 in interest over the year, this amount can often be deducted from their taxable income. This deduction lowers their taxable income and, consequently, their tax bill. In real estate, mortgage interest is another significant tax deduction. Homeowners and real estate investors can deduct the interest paid on mortgage loans used to purchase or improve properties. This deduction can be particularly advantageous for individuals with large mortgages or multiple properties. For example, a real estate investor with a mortgage on a rental property can deduct the interest payments from their rental income. This deduction reduces their taxable income and increases their cash flow, making real estate investments even more lucrative. In the world of investing, margin loans, loans taken out to invest in securities, can also offer tax benefits. The interest on margin loans used to purchase investments is often deductible, which can offset the cost of borrowing and enhance investment returns. Consider an investor who uses a margin loan to purchase stocks. The interest paid on this loan may be deductible, reducing the overall cost of borrowing and increasing the potential return on the investment. Real estate is a cornerstone of wealth-building strategies for many affluent individuals. Leveraging mortgages to acquire and manage properties can lead to substantial financial gains through rental income and property appreciation. Mortgages allow individuals to purchase properties with a relatively small down payment while financing the remaining amount. This leverage amplifies the potential returns on investment, as the property's value and rental income are generated based on the full purchase price, even though only a portion of it was paid upfront. For example, if an investor buys a property worth $1 million with a 20% down payment and finances the remaining 80%, they only need to invest $200,000 of their own money. However, the rental income and property appreciation are calculated based on the entire $1 million value, maximizing the return on their initial investment. Rental properties provide a steady income stream, which can be used to pay off mortgage debt and generate additional cash flow. The key to success in rental property investment is selecting properties that offer strong rental yields and managing them effectively to minimize vacancies and maintenance costs. A wealthy investor might acquire multiple rental properties, diversifying their income streams and reducing the impact of potential vacancies or market fluctuations. This strategy ensures a stable and growing source of income, contributing to overall wealth accumulation. In addition to rental income, property appreciation contributes significantly to wealth building. Over time, real estate properties tend to increase in value, providing investors with capital gains when they sell. This appreciation can be leveraged to acquire additional properties or reinvest in other opportunities. For instance, an investor who purchased a property for $500,000 10 years ago may find that its value has increased to $800,000. By selling the property, they can realize a significant profit, which can be reinvested into new ventures or used to pay down existing debt. Debt can be a valuable tool for business expansion, enabling entrepreneurs and business owners to fund growth initiatives and increase their company's value. By using borrowed capital strategically, businesses can scale rapidly and achieve significant financial success. When expanding a business, entrepreneurs have the option to choose between debt financing and equity financing. Debt financing involves borrowing funds that must be repaid with interest, while equity financing involves raising capital by selling ownership shares in the company. For many business owners, debt financing is preferred because it allows them to retain full ownership and control of their company. Additionally, interest payments on debt can be tax-deductible, making it a cost-effective way to fund growth. Businesses often use debt to finance various growth initiatives, such as expanding operations, purchasing equipment, or investing in research and development. By using borrowed capital to support these activities, companies can increase their revenue and profitability without diluting ownership. For example, a tech startup might take out a loan to develop a new product or expand its marketing efforts. The increased revenue generated by these initiatives can offset the cost of borrowing and lead to greater overall profitability. While debt can facilitate business growth, it is essential to manage associated risks effectively. High levels of debt can lead to financial strain if the company faces unexpected challenges or if revenue growth does not meet expectations. Implementing sound financial management practices and maintaining a balanced debt-to-equity ratio can help mitigate these risks. Debt recycling and infinite banking are innovative financial strategies that wealthy individuals use to manage debt and build wealth. These approaches involve leveraging existing debt and using specialized banking techniques to enhance financial growth. Debt recycling involves converting non-deductible debt into deductible debt by using borrowed funds for investment purposes. For example, if a person has a mortgage on their primary residence, they can refinance the mortgage and use the proceeds to invest in income-generating assets. The interest on the new investment loan may be tax-deductible, providing a financial advantage. The infinite banking concept involves using a whole life insurance policy with a cash value component to create a personal banking system. Policyholders can borrow against the cash value to fund investments or cover expenses, with the insurance policy serving as collateral. This strategy allows individuals to access capital while continuing to build wealth through the policy's growth. Consider an individual who uses debt recycling to enhance their investment portfolio. By refinancing their mortgage and using the borrowed funds to invest in real estate or stocks, the individual benefits from tax deductions and increased investment returns. This approach allows for more effective debt management and wealth accumulation. A wealthy individual might implement the infinite banking concept by purchasing a whole life insurance policy and using the cash value to invest in various opportunities. By accessing funds through the policy, the individual can maintain liquidity and continue to grow their wealth while leveraging the policy's benefits. Margin trading involves borrowing funds from a brokerage to invest in securities, amplifying potential returns but also introducing additional risks. Wealthy individuals often use margin debt as part of their investment strategy to capitalize on market opportunities. Margin trading allows investors to purchase securities with borrowed funds, increasing their potential exposure to the market. For example, if an investor has $100,000 in cash and borrows an additional $100,000 on margin, they can invest $200,000 in securities. If the investments perform well, the returns can be substantial, as the gains are realized on the larger investment amount. While margin trading can amplify returns, it also increases the risk of losses. If the market declines, the investor may face significant losses and may be required to repay the borrowed funds, regardless of the investment's performance. Proper risk management and a thorough understanding of market conditions are essential for successful margin trading. Interest on margin loans is typically tax deductible, which can offset the cost of borrowing and enhance overall investment returns. Investors should carefully track interest expenses and consult with tax professionals to ensure they maximize available deductions. Leveraged buyouts, LBOs, involve using borrowed funds to acquire companies, often resulting in substantial returns for private equity firms and investors. This strategy relies on the target company's future cash flows to repay the debt and generate profits for the investors. In a leveraged buyout, a private equity firm or investor acquires a company using a combination of equity and debt financing. The debt portion is typically secured by the target company's assets and future cash flows. The acquired company's operations and financial performance are then used to service the debt and generate returns for the investors. LBOs offer several benefits, including the ability to acquire companies with relatively small amounts of equity capital. The use of leverage enhances potential returns, and the target company's cash flows can be used to repay the debt. Additionally, LBOs can provide opportunities for operational improvements and strategic growth. The primary risk associated with LBOs is the reliance on the target company's cash flows to service the debt. If the company's performance declines, or if market conditions worsen, the debt burden can become unsustainable, leading to financial difficulties. Thorough due diligence and risk assessment are crucial for successful LBO transactions. Ultimately, the strategic use of debt can offer substantial opportunities for wealth accumulation and growth. By learning from the approaches of the affluent and applying these lessons thoughtfully, individuals can explore ways to utilize debt in their financial planning, ensuring that it serves as a tool for advancement rather than a source of stress.